The last time we were here in this room, it was right on the heels of a speech by Secretary Geithner in the Financial Stability Program. And today we reconvene, and it's also on the heels of, well, what I call the State of the Union address by President Obama. So I'm very happy that the federal government obliges us by providing some sort of backgrounder for us to have something to talk about for these sessions. Now, my job right now is to basically give you an update on what happened in the financial services sector from the last time we were here on February 11 to today, to this morning really. And I have 20 minutes to do that, and since there's so much that happened, I'm going to just really rattle very quickly and try to cover as much ground as I can. We have prepared an events template, and it should be on your tables, and that should give you a more comprehensive flavor of what's been going on. I'd like to start out by basically touching on a few things. The first is, well, we can't ignore that the Stimulus Act, the American Recovery and Reinvestment Act of 2009 was signed by the President on the 17th of February. Now, there are lots of portions there, and if you have the better part of a day, it might be a good exercise to actually go through it. However, I'm going to concentrate on the financial services side of it. Basically, and the relevant portions for the financial services industry center on executive compensation and whatnot. First of all, let's talk about coverage. The provisions of the Stimulus Act really cover all TARP participants, sponsors of asset-backed securities which have been pledged as collateral for TARP facilities. And one thing that has to be made clear, the coverage really extends, for the most part, to senior executive officers. Now, this has been defined as the top 5 most highly compensated executives of a company. Prior to that, when Secretary when Treasury came out with its version of this, it really targeted the top 25 executives in a company, but that's been kind of modified. Now, the duration of these provisions, really, the prohibitions will extend for as long as a company or a financial institution is receiving financial assistance under TARP. Now, just to summarize, basically the provisions go into executive compensation. There's a limit on the incentives which the SEOs, as senior executive officers, may receive. There is a sliding scale of how much of the scope, and these are all in the events template. It goes on to talk about compensation committees that have to be formed, luxury expenditures, executive pay must be subject to shareholder approval, which is non-binding, by the way, and there's a retroactive review. One thing I want to highlight is the modifications to the Treasury guidelines, which were issued on the 4th of February. The first is that the Stimulus Act provisions apply retroactively. The Treasury guidelines were meant to apply prospectively, but the Stimulus Act basically retroacts that. Second is the limitation on annual compensation of $500,000 is for senior executives is modified in the Stimulus Act. Other than those receiving exceptional assistance, this may be waived for most TARP recipients. Okay. The second big announcement in the last 2 weeks was the Homeowner Affordability and Stability Plan. And this came in the middle of last week at the heels, actually, of the Stimulus Act. Now, basically, there are basically three parts to this particular act. The first is the refinancing of up to 4 to 5 million mortgages for what they call responsible homeowners. The second portion of this is the creation of the Homeowner Stability Initiative, which they hope to reach up to 3 to 4 million at-risk homeowners. The third is basically a strengthening or support, a strengthening of support for Fannie Mae and Freddie Mac. In sum, basically these provisions, these health provisions, are meant for folks who are in their present homes. They're not meant for folks who are basically buying houses for investment or who want to flip their investment over. There are a series of, just to be very brief on it, there are a series of incentives, both for the lenders and servicers, to actually go in and help homeowners. And there is a component of matching. Basically, if a lender agrees to lessen the amount of interest payment, then the government goes in and matches that on a dollar-per-dollar basis. So, so basically, that's the bare bones of that particular piece of that particular plan. Now, other things which may be notable in the past few weeks, as a part of the Stimulus Act, the Treasury and the IRS have developed guidelines to implement the Making Work Pay credit, which will reduce the amount of money withheld from paychecks. And the implementation of this should start by April 1st. On to other developments. The FDIC, on the FDIC front, there were a number, it was relatively quiet in the FDIC, relative being a relative term. There were a number of receiverships in the Oregon, Illinois, and Florida and Nebraska area of commercial banks. The SEC, now, it was a remarkable week at the SEC. The big event last week was the discovery of another Ponzi scheme in Texas this time, led by a man named Robert Allen Stanford. Now, he was charged last week with running a multi-billion-dollar investment scheme valued at least $8 billion. And that grabbed the headlines, and I think that was the big buzz last week. What was significant also was that there was another Ponzi scheme that was actually prosecuted, started last week. This time, it was a smaller Ponzi scheme, but it was just a $4.4 million Ponzi scheme based in Hawaii. But the egregious part about this is it targeted members of the deaf community, both here and in Japan. So we're seeing more of these things. And is that a sign that things are getting worse, or people are starting to look to other things? You be the judge of that. Also, another news, basically, the Swiss bank UBS settled a complaint filed by the SEC, where basically where the SEC alleged that UBS basically was running an unregistered broker-dealer and investment advisor facility in Switzerland, and their employees were basically coming in from Switzerland to meet up with U.S. clients, and these folks were unregistered. Also buried in the news, and this actually happened on February 11th, a settlement was entered into by the SEC and KBR Inc. and Halliburton Company, whereby Halliburton was charged with violating the Foreign Corrupt Practices Act, and these acts consisted in, I think, in corruption with regard to several Nigerian officials. So, so that was settled last week. Moving on to other things, the FASB announced that they will have available by the end of the second quarter additional guidance on fair value measurement and disclosure. Now, these guidance come in at the heels of their response basically to the SEC's mark-to-market accounting study, which was done earlier, late last year. One thing to note also, there is a bill that was filed in the Senate. It's been called the Hedge Funds Transparency Act, and we're watching it. This was filed actually at the end of January. It should not be part of this discussion, but I just wanted to highlight it. Basically, what it hopes to do is define hedge funds as an investment company, and therefore make it subject to the provisions of the Investment Company Act of 1940, the 40 Act. So we're watching that, and right now it's in the Senate. It was filed by Senators Grassley and Levin, and it will also, and many consider that if this comes to pass, then hedge fund advisors will be also subject to the Investment Advisors Act as a result. In today's Wall Street Journal also, I just wanted to highlight again, there will come out what's being called the De La Rosière report, which will suggest the creation of a pan-European authority on cross-border European banking issues. Is also expected to recommend that a supervisor in EU banks and insurers be created. Which brings us basically to the events of yesterday. But before that, I just wanted to touch on, because, well, there are three things which are interrelated. And the first of these that I want to highlight actually happened last Monday, which is the interagency statement released by the Treasury, the Fed, the OTS, the OCC, and the FDIC. And this was, I guess, well, not really in reaction to, but you can look behind the curtain to reports swirling around that several financial institutions were not very healthy, to put it very mildly. Basically, to summarize the interagency statement, it was a pledge basically to preserve the viability of what is considered systemically important financial institutions. I read that as a code word for institutions which are too big to fail. Basically, it outlines that these institutions will be stress tested, and if these institutions fail the stress test, then they may seek private sources of capital as a first recourse, and failing that, only then will government consider temporary capital buffers, which will come in the form of mandatory convertible preferred shares. Now, this is all in good, but well, and the stress tests are supposed to start today. The timetable for it not really released, but there's a consensus that it should be done by April of this year. The metrics and scenarios which the stress test will take are relatively unknown. I mean, we are basically all we've been told is that we will be taking into account a scenario, a worst case scenario. What the assumptions are exactly, we're left to guess. The other thing that which brings us into yesterday. Basically, the day began yesterday with the Federal Reserve Chairman, Mr. Bernanke, giving his semi-annual report to Congress. And although the beginning of the report was basically a summary of the events from last year leading up to this to yesterday, what most people really latched on is a statement there that if the actions that the government has been taking are successful, then he sees the recession ending this year, and 2010 will be a year of recovery. You know, a lot of people, we hold him to that statement, and hopefully it all comes to pass. The market actually reacted quite well, and I think overjoyed by that. Which takes us into yesterday evening. Basically, the president gave a speech to both houses of Congress. He touched on a lot of things, but we just want to zero in on the financial services aspect. He talked about loans, basically consumer loans, he talked about auto loans, educational loans, and loans to small businesses. He talked about his housing initiatives, which are all good things. And he talked about supporting the banking system, which is also a very good thing. However, there was one statement he made which may have gotten, which has not gotten as much attention in the past 12 hours since that speech. Basically, he called for a change in what he called the outdated regulatory system that we have, you know, i.e. the outdated financial regulatory system that we have. Now, obviously, that's something that has to be elaborated on in the next few days and the next few weeks. Most definitely, anybody who says that the system we have in place is perfect and nothing's wrong must be either severely misinformed or living under a rock. And I'm as curious as the rest of this audience here as to what those updates consist in. And it's been a very fascinating 2 weeks. I apologize for giving you an event template of about 10 pages, but that is already a template that's been culled and edited. It was much longer. It's to say that a lot's been happening is actually an understatement. And but then again, we're ending almost in the middle of a song. After yesterday's speech, what comes next is actually going to be more important, and I expect there to be more developments in the next 2 weeks. So, thank you.